We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners, Burke Britton Financial Partners. Let's rip in. I'm kind of thinking about this and what the purpose of the podcast is. And, I think it's as much for us to kind of distill our own thoughts around what's going on in the market. But I said here that it's kind of born out of our own frustrations of, the limits that we have in the financial planning industry, being able to deliver like relevant, informative information into what financial planning actually is and who it's suited for and actually how it adds value to people's lives. And I don't know about you. Well, I do know about you because we talk about this regularly. There is still a bit of a mystery around what financial planning is. I mean, I'm assuming you still get that every time you sit down with a new client that maybe hasn't heard of us or heard of financial planning before. There's still that question of what do you do?
Even people that have had a relationship with a planner or a professional in finance in the past, there's lots of different takes on it. Like there's still a lot of financial planners who are purely super planners in my mind, or retirement planners, which I think probably our biggest thing is about being across the board, looking at all different areas, not just the one thing. So I think a lot of the apprehension people have is they go, I'm going to go speak to someone and they're just flat out about property investment, or they're flat out about share market investment, instead of what I think we try to sit, and where I think the industry needs to get to is we need to be looking at everything together. So that's probably where I think the biggest misconceptions come from, is probably just from the checkered past of the industry as well.
That I think is definitely the evolution of the industry. That is 100% it. And I think as the industry's evolved, I think we've recognised that unfortunately there's people that are going to miss out. And thinking about why we wanted to do this podcast was to recognise that there's a group of people that need financial advice, or they're going to need financial advice, but the industry and the compliant nature of the industry is probably pricing them out. And having a home for those people, having a place that they can actually come to as a source of trusted information, has been something that I think is missing. And I think we mentioned in our last podcast the rise of people that are unqualified doing podcasts, doing blogs, doing some form of pyramid scheme kind of scenario is where I think potentially the industry heads if we don't sort of capture sort of trusted information and make it available to people that can't quite afford. And even those people that can afford financial planning, but they just don't know where to begin or who to trust. And that, again, is probably the evolution of financial planning, actually giving people an avenue to find a trusted source, whether they're ready for financial planning yet or not. They can listen to us. They can hear us sort of dissect and percolate on our own thoughts and make their own decisions about where someone or a business that they'd like to sort of engage at some point in the future. So I suppose our aim is to give people a bit of a peek under the hood at what financial planning is all about and whether it's right for someone to actually engage us in advice.
I think, again, the world we live in is just ever growing in complexity, and there's so many decisions that people have to make around their financials, it's not simple stuff. They're big decisions. So having someone you can trust and bounce ideas off, I think a lot of the stuff we do now, where I think we get our biggest value add for the clients, is just conversational. Like it's just the sounding board. It's just all those things that go in with it. So it's not go and buy these shares on this date at this price and sell them then. That's just a function that falls under it all. It's a complex world. So like anything, like your medical advice, your legal advice, whatever it is, you've got to know where to draw the line and outsource it. So hopefully we can talk through and explain where that sort of crossover is. And there's some things you can do yourself. It's not to say you can't do things yourself, but being self-aware enough to know when this is above my pay grade or above my knowledge base, I need to speak to someone. That's probably what we need to try and thrash out and make clear for people as well.
And also preparing people. I think the person that comes prepared, that's done some of their own homework, that's taken some sort of personal responsibility the day they walk in, are going to get more value out of advice. So if we can prepare people and get them ready for when it's their time to come in and seek some formal advice and realise that the advice they're seeking is a little bit above their pay grade, then I think we've done our job, and this podcast has probably served its purpose. So if people listen to the end right through to the end of this podcast, I'm sure there's a disclaimer there somewhere, but let's add a disclaimer in here now that it's called the Finances Podcast or the Fine Answers Podcast. That's a play on words, Ben, if you hadn't already known.
Very funny stuff.
Yes. So it's not the Financial Advice Podcast, and that's for a reason. Nothing we speak about takes into account your own personal or financial circumstances, so don't go and act on anything that you hear in this. If you've got questions, hit us up, ask us. Most importantly, take ownership, as I said, of your finances, your life, stay informed, ask questions, seek guidance and direction from a professional when you need it. Don't do anything stupid. It's a bit of a no-brainer, isn't it?
Simple.
All right, so I haven't introduced us. I was trying to do a little host intro, and I've realised that we've really got, other than being financial advisors, we're pretty boring. Two pretty boring blokes, financial advisors, certified financial planners. What else? We better add some stuff. We better.
So you got 5 kids. I haven't got anything to add on that front.
Well, you're a better golfer than I am.
It's true.
What else? You still play football?
Try to, not very well. Not a lot else. Try to play cricket, not very well.
We're going to have to fluff our bios up, mate. We have to find some exciting things that really get the listeners in. Now, in talking about this podcast, we're always at danger of continuing to talk for hours, and we thought we'd have a little bit more structure than our previous 5 podcasts and break it up into a few sections. So the first one is that we're going to have a core financial planning topic, and today we're going to have a crack at cash flow management and sort of budgeting. We've taken a snippet from the Money Smart website, which you can find on our Burke Britton Financial Partners website under calculators. Next one, we're going to talk a hot topic, which is property FOMO, which is obviously very relevant at the moment. If we get time, we'll talk through a strategy around debt recycling. We might even cover a market update. We've got no book review. We haven't read any books. You haven't read any books for about 5 years, Ben, so I'm not sure how.
Right. I don't think anyone wants to hear about my last. I think it might be a Nick Rewalt biography or something. It's probably not too exciting.
Maybe we'll get Rue on the podcast.
I think he's busy on Celebrity MasterChef. So
yes. Well, maybe get Thorpe and Nick on. Speaking of guests, we have none, so it's just you and me today. But the aim is that we will have some guests on to mix it up and stop listening to us. So let's hook into budgeting and cash flow management. And again, the purpose of this was to try and have some anchors or some pillars of financial planning that we put out there. Again, not advice, but giving people an opportunity to get their house in order, maybe either by themselves, in readiness for some financial planning advice, or just because you should. So again, I said that there's a link on the Burke Britton website. That's www.bbfp.com.au under calculators, budget planners, and there's a link to the moneysmart.gov.au website, which again is pretty basic, but I think that's where we're starting. All right, so having a budget, and this is straight off the website too, having a budget helps you feel in control of your money. Wow. You can put aside money for big bills when they arrive, plan savings, and achieve your money goals. Well, that sounds
very exciting.
Yeah.
I think cash flow is I think we've said this multiple times on the first few podcasts. It's sort of the start and finish of everything. If you've got good cash flow, you feel good. If you have poor cash flow, that's normally where the stress comes from, and it usually flows on to detriment of all other financial inputs, your assets and things you've got. So again, you've probably seen this a million times as well, but it doesn't necessarily matter what people earn. I think that's probably one of the biggest things. It doesn't matter what your income is, single income, double income, 5 kids, no kids. People have cash flow issues all over the place. And I think that's probably the first thing is ignore what you've got coming in for a start and just work out what you've got going out, and management and just a system. Just systemization sounds so boring, but boring is good when you know you don't have to worry about the bills. You've just got them set up and they're just humming along, and you can focus on living rather than saving and having to manually pay things and juggle bills and all those boring life things that go with it.
I'm sure every time I've said budget to a client, they've rolled their eyes. And I think for me, the most obvious thing is that the majority of people have no idea what their cost of living is. If you ask people what their cost of living is, they have no idea. And for me, it is showing people or giving some people some awareness of what comes in and what goes out. I mean, that in a nutshell is what budgeting is, and trying to look at your household. It sounds a bit corny, but looking at your household like a business, essentially saying, okay, my intent has to be profitable. I have to be earning more than I spend, and then whatever's left, I've got to make good decisions with. So back to the website, setting your money goals. So first work out why you want a budget. So this is the question of why. So giving you or helping you decide where you want your money to go. 2, asking yourself, what's my goal? It could be to stay on top of bills, save for emergencies, pay for kids' education funding, or save for holidays or a house deposit or investments. So the question of why, like, why am I doing this? That is an obvious one, but it's one that people miss altogether. And that idea of actually giving people some objectives. Most people have some sort of loose idea of what they want to do, but it's not until you sort of give those some sort of order of priority that you can then link it back to a budget and say, well, here's what I'm trying to do. And in financial planning terms, they're what we'd call sort of financial and lifestyle goals. And as a planner, our job is to help you if you can't identify what your goals are or why you actually need to be doing a budget in the first place, giving you some support in identifying them and then helping you execute those in line with a budget.
I think it sets you up for most things. And one of the longer term ones with money goals is people no doubt want to retire early or whatever it may be, but you can't plan to retire or plan to do anything if you don't know what you're going to need at that point. Like anyone could retire, but can you actually sustain your lifestyle and sustain what you need to live the life you want to live or are living at that point in time? So it just gives you something as a cornerstone to base things around as well. So you can put that right out at the end. That's probably the longest term one for most people. You set that in the ground and say, I need X amount per week, month, year, whatever it is. And then you can work backwards in your planning to make sure you can actually achieve that. So I think, again, it sounds boring. I think people overlook it. Probably more people overlook it when they feel they're super comfortable and they're cruising along and they are accumulating wealth than people that are maybe just getting by, whether that's that they're on a single income at that time or they've just started a family or something. Those people are almost more inclined to budget. So the people who actually got better income and don't feel the need to do a budget actually end up sometimes not as far ahead as they should be because they didn't know what their cost of living were and they didn't know what they needed to set aside. And sometimes they haven't planned for the worst case event. It's a bit of a vicious cycle.
Yeah, and it's right. You're right that sometimes the people that have the least are the people that are probably the best and the most. And sometimes budget is kind of a bit of a dirty word because a budget gives the perception of having to be super frugal and having to scrimp and save and not enjoy anything from a lifestyle perspective. The reality is it's money in, money out, having awareness about where it goes, making sort of informed choice about what you do with that. So I think, so back to the website, seeing where your money goes, having a clear picture of your regular expenses and spending habits will help you set up your budget. So to do this, track your spending over a week, a fortnight, a month, and there's multiple ways of tracking your expenses. Again, when I've sat in with clients before and asked them what their cost of living is, most of them look at you blankly. Some of them will have a reasonable idea, but they'll miss half of their expenses. So they'll have all of their sort of fixed expenses down pat, the stuff that they have to spend money on, but it's the discretionary stuff that generally gets people in trouble.
I think there's a lot of people come in and you talk to them and they go, oh, we live a pretty frugal life. Like they believe or they've convinced themselves that they don't spend a lot of money on non-discretionary items, but they've never actually sat down and worked through to realize they actually probably do. And it's not one big spend each week. It's just the sum of multiple expenses over the period, whether they're just blowing it on every day they eat out for lunch at work or whatever it may be. And it's across the week, they
death by
do
1,000 cuts.
Exactly. And that's where most
people... Did I steal that off you?
That's a good line. I do use it a lot. So I think that's where most people go wrong is they feel like, I don't go and buy $300 worth of new clothes every week, but they actually accumulate $200 a week of spending on buying their lunch and 3 coffees and all those little things. And it's more just about being aware of that. And if that's something you go, you know what, that makes my life better, that's something I really want to spend money on, that's okay. It's more about when you think that you don't have that expense, but you do. $5,000 a year is roughly $100 a week. So it doesn't take long for it to become a massive amount of money coming out of your bottom line. So it's just that awareness thing is something that we probably see a lot. People, they say to you, oh, this is what I need. I think this is what I can spend. But they've never actually done the budget or lived through a period of tracking to actually see it's not even close.
Yeah, it's a guesstimate, which is probably the next step, which is how you actually set a budget. Again, rather than having it as a work of fiction that in your mind you think you're sticking to a budget, use a tool. I said it before. There's a couple of good calculators on our website. So under calculators at the Burke Britton website, there's a couple of online calculators and an Excel spreadsheet. The first idea is to actually record your income. Isn't it interesting how many people don't know how to record their income? So net or gross. So actually knowing that you've got your gross is before tax and your net is after tax. That's a pretty
probably
important
even a step before that is I don't know how many people I've asked, what's your income? And they actually don't know. Like they know roughly what goes into their account, but they don't really know. You go, you're on a fixed salary. It varies a bit.
Does it include or exclude super?
Yeah, all those things. And they don't really know. And they even on their payslip, it just has a range and they're not really sure on that range where they are. And it's maybe for people like us who are very focused on the detail of that, we find it a bit strange, but it always sort of startles me still a little bit when people don't have a clue what they earn, or they turn and look at their partner to ask them what they earn, or they go, I think last year my tax return said this. If you don't really know what you've got coming in, it's hard to plan what you can afford to go out. So
it's kind of hard to make any sort of informed decision. If you don't know what the actual figures are. I get it. I get the fact that sometimes ignorance is bliss and you get a lot going on in your world, but it's important. It's important, and sort of capturing or having an understanding of what you actually earn is pretty critical to making good investment decisions, financial decisions, lifestyle decisions. And again, for those people that have got no interest in making financial investment or lifestyle decisions, it really doesn't matter. But for those that do, which is hopefully the people listening to this, it's pretty important. Understand what your income is. Number 2, recording your expenses. I know we've got lots of different ways of actually doing this. Probably the best way I've found and the simplest way is just writing it down. So there's a couple of really good free spreadsheets that you can record all of your, what we call your discretionary expenses, all the stuff that you choose to have, all of your non-discretionary expenses. So that's all of your utilities, rates, household expenses, medical expenses, car costs, loan repayments, credit card, mortgage repayments. It's important to capture everything. Like I'm sure you've looked at many budget before, Ben, and just a couple of probing questions soon identify that people have left out a huge swath of expenses. And I know that even without doing a budget, one of the clearest ways of identifying whether someone's in surplus or deficit is, do you have a bank account that grows or decreases in value? Do you have a credit card that you cannot pay off? Straight away, that's going to give us an indication about whether you spend more than you earn or earn more than you spend. And as financial planners, that's then got us digging for the reasons why.
Yeah, it's definitely a case of working backwards in that first instance to see where are they at. And again, sometimes they might not have had the chance to complete that budget at that point, but you can get a feel for where they're at. It's pretty scary the amount of times people maybe verbally are telling you that they think they're okay, but you can see they've got accumulation of credit card debts, they've got maybe redrawn off their loans, etc., etc. And you sort of think they sort of paper over their own cracks in a way. They always can pay the bills and they can go out for dinner and they can do all those things, but they actually are digging themselves a little hole in the process. So again, I'm sure you've seen that multiple times over, but it is an interesting process to work through. I think so many people it's an eye-opening thing to just actually see what they've got going out on a regular basis. So sometimes we're all guilty. Again, I've seen this again with myself. Even you might have a loan with one bank, an account with a different bank, and you end up sort of having a spread of expenses and a spread of outflows. So you're struggling to see clearly where things are going. So sometimes it's just about that systemization to bring it back into one place for a period of time so you can actually see it clearly, track it, record it, and then you can plan from there on the other side of it. So again, you have two people come together and form a couple. Financially, they bring their things together, but they're running separate systems. All those things actually erode and make it difficult to see what your regular outflows are. So just overcoming those is super important.
Agreed. So seeing if you can save, so a surplus or a deficit, I think we've probably talked to that already. The things that I see that probably catch people out, the things that don't kind of fit in a budget. So you've got, again, education-wise around expenses, we've got discretionary expenses, the stuff you choose to have. You've got non-discretionary expenses, the stuff you have to have. And then you've got these sort of irregular, maybe call them capital expenses, the things that come up irregularly, or the things that you've actually, are coming up, they're planned, and you haven't factored them in. It might be not only expenses, but income. What one of the spouses is going to have some time off work, actually factoring that into your budget is pretty important. Understanding whether you're in surplus or deficit. Do I spend more than I earn or earn more than I spend? I've already spoken about that. And I suppose the thing in wrapping the budget up is probably this is something that you can do yourself. I mean, this is something that if you walk into the door at a financial planner's office and you've done your homework and you've got an idea of your cost of living, you know how much surplus or deficit you're in, you're about 3 or 4 steps down the path of making good, effective use of the time that you spend with a planner. I had a couple of other points here, Ben, around just how you sort of manage that budget, and you've probably touched on these a little bit already, but one of the things we like to see people do where possible is have, as you said, sort of one source of the truth. So if that's people having multiple bank accounts, trying to rationalize those down to a smaller amount so you can actually see the inflows and outflows, trying to automate as much as possible. One of the things that I think a lot of people see is that they're so panicked about not having enough money in the bank when it comes time to pay their bills that they hold off. They don't automate. So they create this huge workload for themselves of manually paying bills and kicking the can down the road of bills that they don't believe they can actually afford to pay. Whereas if you have a budget, you know how much surplus you're going to be in, you know exactly how much you're going to have in the bank, you can then set and automate a lot of those expenses, the direct debits for credit cards and bills, knowing with full confidence that there will be, in fact, enough money in the bank to pay those bills when they come due.
I think that they're probably seeing this as well, as so many people have irregular income, whether that's they're through casualisation of workforce or they're nurses getting overtime in certain weeks or night shift allowances, or they work in sales and they get paid lump sums once a quarter or whatever it may be. If you can control that yourself and have that account where all your income goes to and the bills automatically come out of that and then your spending is removed from that. It's one of the big issues. I see people go, oh, I've got to tight, this month's a low pay month, things are tight. Instead of smoothing it out, smooths them out mentally and calms them down, and then they know it's sorted. They know that it doesn't matter whether this pay, it's an extra 50% on the last one because I've already set that aside. It's all set aside. It's automated. It's low touch. And I know it will work and trust my inputs to work. I think that just flows through, gives them comfort, allows them to think a bit more positively about it. Instead of you feel like you're putting out fires all the time, and people that are chasing bills and variable income, and every second fortnight I put $750 to the mortgage and the other one I only put $300, and they end up consuming themselves with transactional use, which is just not productive really.
I think one of the other things that we see is people spend, when I just said try to rationalize things down to one pot or one source of the truth. The danger or the contradiction there is that when people have one big pot that they spend out of, they see 10 grand there 1 month, they'll spend it. And one of I think the best strategies that I've seen work for people is to actually separate their discretionary expenses. And that might, back to treating yourself a bit like a business, actually working out what your play money is going to be for the week, what your discretionary money is going to be for the week, whether it be for meals and entertainment, lunches, coffees, beers, whatever, and physically pay it to yourself either into a separate account that has ATM access, or physically take it out of the wall and have it in your wallet. Again, that just sometimes that mental barrier between the large pot where money comes in and goes out and what you spend on a discretionary basis, that sort of mental wall can be a savior. And I think for a lot of people, that's it. Getting into good disciplined habits about managing their cash flow is the starting point. It's funny how discipline keeps coming up in these conversations.
It sounds so simple, but we know for a fact that so many people don't do it. And people probably know they need to do it, but they just don't do it. And for the longer they put it off, the further they sort of set themselves back with all of those other items in their financial life, all their goals, holidays, buying a home, all those things. It's easy just to let it drift along. It's easy just to keep rolling with what you've got. So just taking a little bit of control, simplify it. And yeah, I think that's the key with probably all of our stuff, no matter what sort of planning we're doing. We want it to be user-friendly, simplified, low input from you. Just automate it, keep it simple. It'll work. Trust the system.
Trust the process.
And trust that process. And if you do that, it works. And discipline is a difficult thing for some people. So if you can try and almost take that away, like just know, I don't have to think about it. I don't have to be conscious of this. that's when it works best.
This might be a good segue into our next topic, because it's funny how people who have no idea whether they spend more than they earn or earn more than they spend and don't know what it costs to live, their first foray into financial planning is, I've got to buy a property because it's my next door neighbour is, or I'm going to miss out. So the next topic we had was around, this is one of your pet ones here, Ben, was property FOMO. And we went hunting for a little bit of info. We're going to sort of reference a couple of people in the industry. There was a blog post from your old mate, Bryce Holdaway, Ben, from the Property Couch. Good podcast, actually. Location, and he's actually one of our, well, I wouldn't say he's our opposition, he's one of our peers. And he had an article, it didn't actually have the date of the article, the blog, but just talking about what FOMO is and what property FOMO is and why we should avoid it. And I'm going to go straight to his article. It says, FOMO is very much the story of a significant portion of the Australian property investment market right now. He says there, especially in Sydney. I think he's based in Sydney. There might also be in Melbourne as well. But unfortunately, for those investors who fall victim to it, it could all end in tears. So property FOMO, Ben, I think there's a little Wikipedia definition there. But from your experience, what are you seeing with people having sort of fear of missing out in the property market at the moment?
I think it's a real thing. It's not just something talked about. There's 100% people out there spending more than they probably should, purely based on the fact that they're either impatient with looking for something, or they do have that genuine fear of missing out and that they're just going to keep running ahead of them and they'll never be able to get into the market, which, again, it probably has happened to people in the past. That it's not that would be a factual thing, that there's people that have probably could have got in, hesitated and not done it. And probably sometimes that just comes back to their actual layout of their planning and knowing they're actually ready for it and not pulling the trigger when they are ready. Kind
of back to discipline, isn't it?
It's a bit of
having a plan.
Yeah, and that's the ironic thing, is that then by not being planned and organised, they actually didn't enter the market when they probably could have, and then they put themselves back by then chasing a market that's hot at the time. So again, a lot of this is probably anecdotal, but you see a lot of the purchases that are happening in the market aren't necessarily investment. There's a lot of owner-occupiers, so they're the more emotional buyers. So they're the ones that when you get to the auction, there's two people going toe-to-toe. They've already fallen in love. They've already packed their bags. They're ready to move in. So they keep on going and they blow the prices up. And there's a lot of that happening. And that's a combination of a lot of factors we've got at the moment. It's a very unique time because we've got people who want to get out of cities, get away from lockdowns and restrictions, even though they are on the ease now. So there's a lot of other factors going into it. It's not a rational market in my mind at the moment when people are buying. That there's more love than there is finance sort of backing to their purchases. And it's a good time to be selling. It's not a great time to be buying or trying to get into the market. So again, it might sound like you're saying don't buy now. It's more about just being aware and knowing what that purpose of the property is as well. Is it somewhere that you want to be for 20 years, 30 years? It's a long-term home. And that's a bit of a different story. It's more if you're looking at it from a pure investment, or, I just want to get in here for a couple of years and then try and flip it up to something bigger. That's when you probably run your risk. And it's like any investment. The longer your time frame, the safer you'll probably be. You've got time to endure ups and downs. There's going to be a lot of things go on in the property market. And we could probably talk about this for hours on end, and I'll try not to get too off topic, but people trying to sell property. So you've got agents and the like who are pushing it, and they'll keep stoking that fire to fuel the FOMO effect, because it's good for business for them to do so. And we're probably, Jay and I are probably the bit pessimists, or I think that we both
think you call us realists, Ben.
That's a nicer term. We've seen it all go wrong for people. That's probably the bottom line. They overextend.
I think our advantage in where we sit is, and I wrote a couple of things as you were talking, that you said that it's a unique situation, and it is, but it also isn't, because the same emotional response that you're seeing from people with property, you've seen with other asset classes, and you've seen with super big hype around particular investments. I mean, crypto. Yeah, there's plenty. And so half of the battle, which is back to this sort of personal responsibility and having some discipline in your decision making, is the ability to sort of detach a little bit from the emotion of a decision and just look at things on the hard and fast facts, like what's actually going on. And I think I had there was another article there, which I'll give her a shout out. So Michelle May, buyer's advocate at Michelle May Buyers in Sydney, April 30, so a bit earlier in the year, 2021. And she's talked about the key ways to avoid getting caught up in FOMO. I think we've probably talked to a few of them, but that I think you mentioned right at the start, she says, number one, stick to your list of must-haves, which is kind of realizing what you're actually doing. Like, why are you buying this property for you at that time? Does it actually suit your needs? And is it within your means? If you can't answer those questions honestly, then it's probably not for you. And if you're walking into a property purchase without a plan of why you need this property, then you probably got to step aside. You got to step back and actually wait your turn.
Yeah, I was going to say, I think it's so much of the why, and that's with property, or if you're going into the share market or whatever investment or business, whatever you're trying to enter, you've got to have a why to why you're doing it, to then rationalize that through the process of, does this fit? And that's why if you're buying something that you plan to, why, or we need a bigger home that we've planned to live on for the next 30 years, well, then you can make extensions to that in terms of, right, well, we're happy to overspend maybe a little bit. We understand the market is what it is. We don't plan on selling it for a very long time, so we can push on. If you're chasing it because you are desperate to get into the market, or you want an investment property, you need to assess the why. Like, why am I doing that?
That idea of being desperate. I mean, as soon
that's
as
a
I hear
bad
that,
sign.
I'm thinking that's...
It's good for sellers. It's good if a person listing their home, or an agent hears them say, "Oh, we're desperate to get into the market." They're going,
great. They're
awesome.
emotive.
Yeah,
ready to roll.
It's probably go sidetrack. But when people sell houses now, there's a lot of strategy that goes into it. They go, right, we'll target markets, young first home buyers. Let's polish this thing up, put some nice furniture in it, make sure when they walk in, they can see themselves sitting there watching TV or whatever it is, and they will just keep opening the pockets.
And that's cool, and that's business. But as the consumer on the other end of it, you've got to be aware of it. The number 2 of this article was "Don't believe the hype," which is kind of that. It's more just being aware, like have some awareness that there's hype. They're going to be trying to shine out some pieces of dog shit for you to buy and keep you opening your pocket. That's fine, but just be aware of it. The third one was pay attention to what's going on in the world, which again is just have your eyes open. It's number 3 and 4 here. Pay attention to what's going on in the world and do your own research. Like, be aware about what's happening. So think about what's going on in the world at the moment. What are the reasons why the property market has taken a huge jump over the course of the last sort of 12, 18 months? So we've got a global pandemic. The government's stuffed people's pockets when they haven't had to work. We've also seen people not being able to travel, so discretionary spending's gone down. People are questioning when they'll be able to travel or do things again.
People push into regional areas to get away from those, essentially break the lockdown. So get out of it forcibly by moving to regional areas, which I think is probably where you see most of the run up and risk as well.
And then you've got interest rates at historical lows. So you combine all of those factors together, and if you step back for a minute, you can see why the property market has exploded over the course of the last 12 or 18 months. Now, like you said, Ben, it's not about saying it's not the right time to buy, but you have to work out why you're buying in the first place, and then make sure that it's actually done within your means. If you haven't got those boxes ticked, then it's time to, which is point number 5, get a second opinion and go and talk to someone, which is, again, this is a blatant plug for what we do.
It's almost should be 0.1, not 0.5, but
it's actually get some advice. But first and foremost, get some advice. And maybe doing your own research comes before getting advice, or maybe doing your own research includes actually getting advice. But having someone that's a third party removed from the situation, is not emotionally involved, help you piece out what you want, why the market's doing what it's doing, and making sure it's within your means, I think is critical.
Definitely. I think when you want something, and we're all guilty of it, is you say you've got 2 people and they both want to buy a home as a couple, they're both feeding that, putting fuel on that own fire of wanting to do it, and you will look for positives. You try and justify it to yourself why you've got to get in now, you've got to do it now, rates are low, the market's going to keep going up, if we don't do it now we won't ever get in, all of those things. And that's a dangerous mix. And it might not, you might end up still being the right time to buy, but if you don't go and outsource, get a second opinion, just get a contrary view of it to just level yourself out a little bit. I think that's crucial. Sometimes you have to compromise on things. Like, it might be, look, realistically, if you're going to get into the market, you need to slightly different area or something. But at the same time, people over compromise and end up with an inferior outcome just so they can get something. And that's probably going to be the long-term part that stitches people up the most, is when they end up going away from their core reason why they were doing something. They wanted to live in this area and they knew they wanted to be there for a long time. They couldn't do it, so they stretched, and they ended up going down the road, and then they ended up getting a smaller house, and it ends up not fitting their needs long term. And then they get caught in a cycle of having to unwind previous decisions. So I think unwinding is one of the biggest expenses in anything people go through, whether that be their personal arrangements, their financial arrangements, whatever it is. You need to really lay those things out and have a clear guide. And things will go wrong. That's probably the other factor too. Is you might be thinking, oh yeah, we can make this work. That's also a dangerous term. I don't like hearing too much where they go, oh, we could make it work if X, Y, Z. But normally that's a sign that's probably close to the edge. Like it's probably...
That's a sign that we can probably make it work today, but we haven't, and we don't really want to. We've put our head in the sand about what things are going to look like in 5 or 10 years' time. And I think, I don't know how many times I've said this, but what part of our job, one of the main parts of our job in investing, again, it's not pessimism, it's realism, and it's about risk mitigation and making sure that we actually identify those areas that maybe people wouldn't identify themselves. And as you said, sometimes that mitigating risk means compromising. It means actually maybe stepping back from what you thought you were going to do and either standing on the sidelines for a little bit longer. I mean, my view is that if you are not in a position to actually tick the boxes and you can't honestly say that you can mitigate the risk of either interest rates rising or property market decreasing in value, then it's actually okay. It's okay to actually supposedly miss out on an opportunity and actually let it go. Again, FOMO is an emotional reaction. It's not really a fact-based one.
100%.
Yeah. How are we going for time, mate? We're going to keep rolling through.
We'll keep going for a little bit. This one, again, this sort of our next topic, I think, was more of a strategy outcome, I believe. So a debrief of a topic, and these, well, we can probably get pretty deep in the reads with it. But
I think the idea here is to give people a taste, because it's nigh on impossible for us to, when we've looked at some modelling on that. So our topic's debt recycling, and we were just looking at some modelling on debt recycling. There's so many different variables, there's so many different assumptions, and back to our disclaimer that this isn't advice. This is just giving people an idea of what's possible in terms of strategy, and you might be able to identify that this might be something that you could explore. Certainly don't go and engage something like this yourself. You're going to need some advice, but understanding how it works. So the idea of debt recycling follows on reasonably nicely from the idea of the property market and the property market growth. So this is kind of the story about how, for those people that have benefited from that growth in the market, or they've been very good with their cash flow management and budgeting and been able to create some equity in their home, what are some things that they can do that can be advantageous both from a tax point of view and also growing wealth, helping with that ultimate retirement plan? So what is debt recycling? Debt recycling is a strategy that aims to help you pay off your non-deductible debt, e.g. your home loan, as quick as possible, while also building up wealth in a tax-effective way over the longer term. It involves replacing or recycling, which is where the word comes from, the debt in your family home with tax-deductible debt from investments.
I think it's the old good debt, bad debt. That's the simple term that gets thrown around a bit with this. And I think people are aware of this strategy, but actually getting it up and running is a bit of a beast in itself. So being aware of, am I ready to do it? What are the risks associated with it? Where do I invest the money? What happens next? There's just so many spillovers of it. And I think, interestingly, back to one of the first things we talked about with budgeting, I've had so many clients who complete the budget, or they look at their pay slip each week, fortnight, month, and they go, gee, I pay a lot of tax. What can I do about that?
It's generally people's biggest expense.
Massive expense. So I often say to them, look, the ATO has done a pretty good job. They've actually tightened this up pretty well. There's not a lot of things you can, fudge or claim or do all these things. You've actually got to take on some risk, essentially, such as debt recycling, to manage this. And it's not something that you're going to come in overnight and fix. But longer term, if we set things up correctly, we can definitely save some tax, which is a nice byproduct of the overall strategy as well, which is actually the core of it's getting rid of bad debt and growing wealth overall. So it's a complex strategy. I'm not sure what was going to be your best method of explaining well, I like to use the whiteboard, but a podcast is very useful for that.
And the video camera crashed on us before we started, so we can't do any visuals. But so the strategy involves using equity in your home to invest in sort of income producing assets with the possibility of growth. So over time, the earnings from the investments may be paid towards your home loan, helping you pay off faster than if you were just making regular repayments. So essentially, we are using the equity in your home to invest, so borrowing for investment purposes. The income from those investments then comes straight back and pays off the debt of the home loan, therefore creating more equity in the home and potentially giving you the opportunity to borrow a little bit more, to invest a little bit more, to create more income, and that cycle continues, that debt recycling continues. In looking at some of the strategies that we've employed in the past, one of the things that's clear with debt recycling is it actually does take discipline. Like it actually takes a lot of discipline to make sure that you do in fact direct the income and also might be the tax return to your non-deductible debt, rather than getting to the end of the year and thinking, oh, there's some income, I might actually just take that and spend it. The whole strategy is built on the premise of you using the returns or the income from the investments and directing it off your debt with the aim to either reduce that debt more quickly or end up with a larger pool or end up with a larger pool of assets than you would otherwise have at the end of that term. So the time the debt has actually been extinguished on the home loan.
I think the biggest thing with debt recycling is that, I'll just scribble this down in front of myself, it's not for everyone. And that's probably the thing, again, as any strategy that you hear of, you read, your friends doing it, your mum and dad are doing it, whatever it is, it's not for everyone, and that there's so many factors that would need to be applied. So your age, your income, your goals, your risk appetite, all of those things that factor into it. But when we can work through it, assess that you're in that position to do it and timing matches up well, this is, I think, where probably one of our biggest strategy uplifts for people has been in recent times. I think it's going to be probably links well to the growing house prices and all of those things. Is people have got equity and people have got more debt, so they need to find ways to reduce their debt quicker than simply just sitting on their mortgage and paying it back to the bank over 30 years. So it feels a bit foreign to people to actually take on more risk to benefit themselves. So they sort of
take on more debt to reduce debt.
Exactly. So it feels counterintuitive, and people, the first thing, their natural instinct is pay off my mortgage. And they just want to go, I just want to pay down my debt. I want to get rid of that. Then we can talk about this. And you go, actually, if we can just flip this order a little bit, you can get the outcome quicker. So again, I think probably for most of my clients I've done this with, it's been a process over a 2-3 year period of actually talking about it, getting it in position, and then rolling out with it. I've had conversations with people where they want to do it and they think they're ready to do it, but they don't have enough equity. They don't have enough risk appetite. They maybe don't want to funnel the investments in the right direction. So you can't just be pulling out chunks of your home equity to go and invest in a spec stock. Like, it needs to be things that you've got, treat it like your home almost. It needs to be things that's pretty stable. It's got some risk associated to it, but it's got a good income source. It's blue chip in nature, I suppose, as well. So probably getting a little bit deep into the strategy, but I think that there's just so many factors that...
Well, and I think it's those factors that are so important to acknowledge, because those factors and those variables are where the risks are, which is, it means it's that much more important to make sure that you cover off on the risks. So let's look at what the risks are. So debt recycling is considered a high risk strategy because you're using borrowed money to invest and using your home to secure that debt. If your investment performs poorly or interest rates increase, you could face significant financial stress or even put your family home at risk. So before diving into the strategy, it's obviously important to carefully consider a few things. So again, they're all pretty topical because we've already talked about them, but borrowing money to invest can lead to bigger gains when the market's rising. No brainer. However, when the markets are falling, your losses will be larger as you'll still have to pay interest and repay the loan. So this is something that people always forget when it comes to borrowing for investment purposes, is that as your investment decreases in value, your debt doesn't. Your debt remains there. And so wise decisions about what type, you mentioned it before, making good decisions about what assets you're going to invest in is critical. You can't just pluck any asset out of the drawer to invest in using the equity you've got in your home. If it's for this purpose, if it's for debt recycling, it has to serve the purpose we're actually aiming for. So it's got to generate some income. It's got to have the potential for capital growth. We have to mitigate against those risks of the market declining over time and interest rates going up. All of those things need to be factored in, and they also need to be reviewed very regularly.
I was going to say there's a couple of things. There's some people that are already in a halfway debt recycling scenario. So there's a lot of people that have bought their home, and they thought, investment property. I'd love to have an investment property. They might not have necessarily thought about why they want it, but they go and buy one anyway. So they've got an investment property. So they've got income coming from that other source. They've got debt associated with it. And you do a quick overview of where they're at, and they go, oh yeah, I'm just using the repayments to pay down the loan on the investment property. And you go, okay, so you're reducing your deductible debt portion instead of funneling it across. And it's just little things that sometimes people have put themselves into a debt recycling strategy, but they're not doing it properly as well. And it's just more about them just altering course a little bit, or they've got a big share portfolio that they've used through surplus cash flow over time, but they've still got debt that's left on their home, and they're just reinvesting those returns instead of... So some people have some of the foundations, they're just not getting their flow. And people say, oh, what do? You invest money. I said, no, I reckon most of it's just about flow of funds and having a system. That's a guaranteed return. Like if you can flow your funds in the right direction and save 2, 3, 4 grand a year in tax, well, that's a certainty. It doesn't matter what the market does. You've already saved a few $1,000s, and
it's
as that multiplies,
it's almost that risk-free return. We know what that tax return, that tax refund is going to be, and it doesn't necessarily require us to take any investment risk to actually benefit from that.
Yeah, and that's sort of the core of it, is just getting your structure right. You lock in your benefits through system and just knowing and understanding the rules and setting it up. And it's a complex thing, but if you get that all aligned and humming along, then right, you go, I've already, I know for sure I've made 8-10 grand a year just in my setup and system. Any returns from a growth perspective on top of that, that's the cream right on top of it. Now, if you set it up properly and you've got a long-term ability to maintain the strategy, then you're going to get the growth out of whatever that asset is most likely. So again, I think just sometimes people have half-baked it a little bit, and that's
with the right intention though.
I like the thought about doing something positive. It's then just about making sure it's, you've got everything absolutely A1.
This is that idea of making the most cost and tax effective use of your available income and assets.
Yeah.
You might be 50% there, and that the idea of reducing debt. I mean, we love it when you see people saying, listen, we want to reduce our bad debt, our non-deductible debt. They're all great indicators, then maybe just requiring some tweaking. So I think we've covered off on most of these points, mate. Interest rates could go up, assets could go down. I like this one. It takes willpower and discipline to use the investment income and tax savings for your home loan each year instead of spending it on what you like. And there is that tendency, particularly if your investments are going well, to say, listen, I could scoop a little bit out. And that's not to say that can't happen, but it really does need to be taken in context with the broader plan. Like this is back to the why. What are we trying to achieve here? Are we trying to clear the debt as quickly as we possibly can? Are we trying to grow these assets? Are we trying to clear the non-deductible debt before the deductible debt? All those things are really important. So whenever any one of our clients wanted to change tack from their original strategy, we'd say, hey, talk to us about it first.
I was going to say, it comes back to that conversational thing. It's just picking up the phone, 5-minute conversation. Sometimes all we have to do is just say, do you just remember what the long-term goal here was? And they go, yeah. You just need to hear it. You just needed to have that conversation, and you can work out, right, we started to deviate. And I don't know, it's probably just a modern day thing where we're all a bit impatient with things and we like things to happen quickly. So sometimes we've just got to remember why we set it up and just keep sticking to that plan. And, sometimes we have to deviate by choice or by necessity. But again, it's a long-term grind, some of these things.
And I think you've probably just done a good job of explaining what our role in that is we act as that sort of third-party counsel. We've said it a few times in the podcast already that part of our role, a big part of our role, hopefully a greater part of our role as this industry evolves, is that we spend much more time helping people make those decisions, acting as that sort of third-party counsel when they think, should I do this or should I not do this? We know their situation inside out and back to front. We can have a sort of an unemotional look at what they should actually do. So the last couple of things here in terms of debt recycling, I've just had here, debt recycling checklist. For a debt recycling strategy to work, obviously you need a home loan with some equity in your home. You need some regular income that's generated independently of this strategy. So you've got to, like you said, you've got to have a situation where you're earning a reasonable income. You've got a tax issue that we can take advantage of. A long-term focus, so rather than focusing on a very short-term time frame, we'd obviously argue that a long-term focus is important. A willingness to increase your debt and hold an investment loan, which some people obviously aren't that tolerant of. tolerance for risk and short-term fluctuations in investments, because most of the things that we're going to be investing in with some debt recycling, re-strategy, are going to be probably reasonably volatile then.
That's in any of this, you're adding risk, aren't you? So you've got to be conscious of that. I think the biggest thing with risk isn't an issue if you've got mitigation measures in place so you can lean on. I think the last sort of point was around just sort of risk management planning, and I think there was a mention of income protection. I sort of say to clients, insurance is just one portion of it. Like when we set these things up, we've got to know we've got cash flow, you've got buffer available, we've got investments we can redeem relatively quickly if we need to. We've got other safe reserves, and then we've got insurance if it's something serious, long-term, can't work ever again, can't work for a period of time, whatever it may be. So you've got to have a massive, from a compliance perspective, it's a requirement, but also just from a pure strategy point of view, you've got to have a lot of things in place to pick up the pieces if there's something impacting, or something you can just sort of plug in as a temporary fix if one of the components isn't working for us as well. So again, that's sort of probably not the most exciting part of it, but it makes it a lot more comfortable and a lot more palatable when you know that it's okay if portion A or whatever this part we've plugged into it isn't doing its exact thing for this period of time. So probably reflecting on last year, people had interruptions in income. It didn't matter. We have levers we can pull on these strategies. It's not absolutely locked in. So if something goes wrong, we've got to have wiggle room. I think that's one of our biggest things. Flexibility is the word we probably use a lot. You probably can't use it enough with these things or any strategy really. We've got to have flexibility. If something changes, we've got to be able to move with it.
You've got to have a plan B, C, D, E, and be able to move fluidly, and risk protection is a big part of that. I might finish this one up, mate, just by saying that it obviously isn't suitable for everyone. So if you're considering this strategy, it's important to understand all the risks. So get the advice. Like this is one that you really need to have some support and help with if you're going to implement it. So we hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.